My name is Farhan. Today you are going to solve question number 9 from 2016 past exam. This question requires you to reconstruct the ledger accounts for accounts receivable, accounts payable, and inventory. You're also required to prepare the operating activities section for the cash flow statement. You can check the link in the description to book a call with me and discuss tutoring. With that being said, let's get started. Apcon Air is preparing its budgeted cash flow statement for the 3 months ending 30 September 2016. The business provided the following information. So we are working with a business which has a financial reporting period every 3 months. This means within the span of 12 months, the business will be preparing its reports 4 times because every 3 months the business publishes its reports. We are given the balance sheet extracts as of 30 June 2016, which refers to the most recent actual results. And then we are also given the forecasts for the 3 months ending 30 September 2016. So as you can see, from 30 June 2016 to 30 September 2016, we can see the change in the reporting period from one to the next, which is 3 months. This means the new period will start on 1 July 2016 and will go on for 3 months, July, August, September, and end at 30 September 2016. We are also given the estimated income statement items for the next 3 months ending 30 September 2016, and you are given some additional information as well. Our first requirement is to calculate the following for the 3 months ending 30 September 2016. The cash received from debtors, the payments to creditors, and the GST paid on cash payments. Now, before we move further, I need you to understand something. Because this question came in 2016, some of the terminologies we used before were different. For example, debtors control, as you can see in the balance sheet extracts under current assets, are whom we now refer to as accounts receivable. So the accounts receivable refers to the credit customers of the business. These are the people to whom the business has sold goods on credit. So these customers are the assets of the business. Then we have stock control under current assets within the balance sheet, and the stock control is now renamed as inventory. Pretty straightforward. Now let's get started with the first question, which asks us to calculate the cash that we expect to receive from debtors at the end of the next 3 months, during the next 3 months ending 30 September 2016. So debtors here refers to accounts receivable, the credit customers of the business. So here we have prepared a ledger account for accounts receivable. So you understand that the left-hand side of the ledger account is what we refer to as the debit side, and the right-hand side of the ledger account is what we refer to as the credit side. Now, accounts receivable are assets of the business. We have some economic benefits with these customers, with these credit customers. These customers will pay us back in the future. So therefore, we classify them as assets. Now, the assets are always debited when they increase, and when they decrease, we credit them. Also, the opening balance of assets within the ledger account is always debited, and the closing balance of assets within the ledger account is always credited. So we're going to start with using the opening and the closing balances. So where can we get these two balances? You can check the balance sheet extracts. So you are given the closing balance at end of 30 June 2016, which is $71,000. And because the new period starts on 1 July 2016, this closing balance will become the opening balance on 1 July 2016, and that is $71,000, which is what you can see we have included here on the debit side. 1st of July 2016, opening balance of $71,000. Then on the credit side, at 30 September, we have included the closing balance of $63,000, which is again taken from the forecasts at the end of 30 September 2016 for accounts receivable of $63,000 in the balance sheet. Now, you can check the income statement items. Now, the first thing in the income statement item is the credit sales of $200,000. And I also need you to read the first point in the additional information. It clearly mentions that all sales and purchases of stock are on credit. So we do not really have any cash sales at all. So with conviction, we can say that the credit sales are the total sales for the 3 months ending 30 September 2016, and that is $200,000. So when we're making any sale on credit, when we're making any sales on credit, our accounts receivable are going to go up because the more credit sales we make, the more these people, this group of customers, are going to owe us. So when assets go up, which are your accounts receivable, we debit them. So that is why within the ledger account for accounts receivable, you can see that I'm including credit sales on the debit side to reflect that increase during the 3 months ending 30 September 2016. But I need to include that amount, including GST, because that's how we do business in Australia. So when we sell items to our customers, we also add a 10% GST on top as required by the government. So we as the business collect the GST from these customers, which we eventually pass to the government at the end of the financial period. Now, I want to find the value of this credit sales, including GST, the one that you can see I've included here. So how do we find the amount including GST? The original sales are 200,000 plus an additional 10% applied on 200,000, which is the GST rate for Australia. And that gives us $220,000 as the credit sales, including GST, which is what you can see here on the debit side of the accounts receivable ledger account. Then on the credit side, we have included two items, discount expense and bad debts. Now, these two items are expenses of the business, and all the expenses of the business are reported within the income statement. So you can verify these numbers by checking the income statement, and you'll see bad debts written off $2,000 and discount expense of $1,000. Now, what does bad debts refer to? Bad debts refer to credit customers who are unable to pay at all. So you know for sure these people won't be able to pay you anymore. So that means these credit customers, who are also known as their accounts receivable, they have defaulted on the amount they were expected to pay you. So you have made a loss. So assets should go down. Therefore, within the accounts receivable ledger account, on the credit side, you can see I've included bad debts of $2,000 to reflect that reduction in accounts receivable. The discount expense of $1,000 refers to the discount that the business gives to its credit customers for prompt payment. For example, if I sell some goods to my customers on credit today, let's say for $100, and I've told them, if you can pay this within 5 days, you don't have to pay 100, but you can pay 90. So I'm willing to take a $10 less amount because I need the cash flow in my business. So I could use that $90 from the customer and then reinvest into my products within the business. Now, what about the $10 that I'm unable to now get from this customer? So I write that off as a loss, which is what we call a discount expense. So we call that an expense, and that reduces the overall profit of the business. So that is why if we are giving some discount to our accounts receivable for prompt payment, then obviously that is going to reflect a reduction in the amount for the total that the accounts receivable owe us, and therefore that reduction is reflected within the credit side of the ledger account, because when assets go down, we credit them. So discount expense of $1,000 on the credit side. Now, this amount, which you can see written as bank, that's what refers to the cash we have received from debtors, and that is what we have calculated ourselves. So that is why it's highlighted in yellow. So just assume we do not have this number to begin with. How are we going to find this missing number? So we find the total of everything on the heavier side, which is the debit side. So you add 71,000 with 220,000 and you get 291,000. And that 291,000 must be also the same on the credit side. And then you subtract the closing balance, then you subtract the discount expense, and then you subtract the bad debts. You're left with $225,000, which is what we refer to as the cash that we have collected from our debtors. And we are writing bank of 225 on the credit side as well, logically, because when we are collecting the cash from our debtors or our accounts receivable, they are going down as well. Accounts receivable are going down while our bank balance is going up. So one asset is going up and one asset is going down. So that is why within the accounts receivable ledger account on the credit side, you will see this thing with the bank of 225,000 that we have found, and that is the cash we have received from debtors for the 3 months ending 30 September 2016. The next requirement of the question is to calculate the cash payment to creditors. And we are going to solve this by reconstructing the ledger account for accounts payable and then also the ledger account for inventory. This is because based on the additional information, all sales and purchases of stock are on credit. So purchases of stock refers to an increase in inventory, and because this purchase was made on credit, this is also going to have an impact for the accounts payable. So let's see how we are going to address this. First of all, you can see that because this exam was in 2016, we have all terminology for creditors control. So creditors control is whom we now refer to as accounts payable. So accounts payable refers to the credit suppliers of the business. These are the people from whom the business purchased inventory on credit. So first of all, we want to prepare the inventory ledger account. And as we have just discussed a while ago, all purchases of stock are on credit. Therefore, inventory and accounts payable are relevant to each other in this case. So inventory is a current asset for the business. And all assets by default are debited within the ledger account for the opening balance, and also the closing balance is on the credit side. So what we are going to do is on the 1st of July, on the debit side of the ledger account, we're including the opening balance of 45,000. And on the credit side, we're including the closing balance at 30th September of 47,000. So where did we get this opening and closing balance from? Inventory is a current asset, and current assets are published within the balance sheet. So we check the balance sheet, the stock control, and as you can see, 45,000 is what we have at end of 30 June 2016, which becomes the opening balance on 1 July 2016. And the closing balance at 30 September 2016 is 47,000. These are the two numbers we have used in this case. Now, this amount that I have just highlighted is what we have calculated ourselves. And we're going to get back to this. What about cost of goods sold? Now, cost of goods sold will reduce your inventory. Why is that the case? Cost of goods sold or cost of sales refers to the cost that we had to pay ourselves as the business for the inventory that we originally purchased. So if we are making a sale to our customer, then we're making some profit on top of the cost that we have already paid to our credit suppliers. So therefore, cost of sales, whenever we are making a sale of inventory, we are reducing the balance of the inventory in the business. So that is why the cost of sales is on the credit side of the inventory account, because this reflects a reduction in the value of inventory that the business holds, which are the assets of the business. And that amount is always in the income statement, which is given as 110,000, and that's on the credit side to reflect a reduction in the value of inventory, which also means that assets have gone down. So how do we find this highlighted amount here, which refers to the purchases of inventory that we have made on credit during this 3 months ending 30 September 2016? So we find the total of everything on the heavier side, which is the credit side to begin with. So we add 47 with 110, get 157,000 as the total, which must be the total on the debit side as well. And then you subtract 45,000, the opening balance. And what you get is 112,000, which refers to the purchases that you have made on credit. And that is why we have written here accounts payable. Okay, because the purchases have been made on credit. Now, also need you to understand one more thing. So this amount of 112,000 refers to the original value of inventory. Right, but then we also pay the 10% GST as well. We are obligated to pay this to our suppliers. So including GST, the total amount that we owe our suppliers or our accounts payable are 112,000 plus 10% off 112,000, which gives us $123,200. Now, where do we use this? So now we look into the reconstruction for the accounts payable ledger account. Now, accounts payable is a liability account, and all liabilities by default have an opening balance on the credit side and the closing balance on the debit side. Liabilities, when they increase, we credit them, and when they decrease, we debit them. So on the 1st of July, on the credit side, you can see the opening balance of 25,000, and on the credit side and on the debit side, you can see the closing balance at 30 September of 26,000. Where did we get these two numbers from? From the balance sheet, where we report all the current liabilities. And the current liabilities, the creditors control, who are your accounts payable, have an opening balance of 25,000 for 1 July 2016 and a closing balance of 26,000 at 30 September 2016. Then on the credit side, we're including the total amount of inventory that we have purchased, including GST, and that was 123,200. Why are we including this on the credit side though? This is because the inventory that we have purchased on credit increases our obligation to our accounts payable. This means our liabilities go up. And if liabilities go up, we credit them. And that is the main reason behind why we are doing this on the credit side of the accounts payable ledger account. So after that is taken care of, then we have discount revenue of $750, which is an other income that we add to gross profit when we are preparing the income statement. And this is $750. As you can see, it's given already here. So I'm highlighting that, so $750. So discount revenue refers to the income or the revenue that the business received due to prompt payment made to credit suppliers. So I'll give you an example. For example, let's say today I have purchased $100 worth of inventory on credit, and my credit suppliers, my accounts payable, they told me if I can pay this off by tomorrow, rather than paying it off over a month or 2 weeks, I can pay $80 only. And that means the $20 is what I am able to save, and that is what we refer to as other income or other revenue. So this amount is included on the debit side because this reduces our obligation to our accounts payable or our credit suppliers. And when our obligation goes down, our liability goes down, and when liability goes down, we debit them. Next, this is what we had to calculate ourselves using the same rules that we have done so far for balancing the ledger accounts. So we calculate the total for everything on the heavier side, which is the credit side. We add 25,000 with 123,200, and we get 148,200, which must be the total on the debit side as well. And once you subtract the discount revenue of 750 and the closing balance of 26,000, you're left with 121,450, which is referring to the cash that we have paid for purchases made on credit to our accounts payable during the 3 months ending 30 September 2016. And that's all for the first part, which is question A. And that's exactly how you get 10 out of 10 for the first part. Now let's discuss how we can complete the operating activities section of the budgeted cash flow statement for the 3 months ending 30 September 2016. Actually, I've forgotten to calculate the GST on cash payments as well. So the GST paid on cash payments, we're also required to calculate that. So let me quickly show you that. So the cash payments here refer to the payments that we're making for expenses. Now let's check the income statement for expenses where we will be having GST included. It is the advertising and the delivery expense. Now GST stands for goods and services tax. So both advertising and delivery expense here refers to the services, and therefore both of these will have GST that we will be paying on top of the original amount. So what's the GST that we will be paying on advertising? So the advertising expense, if you check the income statement, is given as $10,000. So we multiply 10% and we get $1,000. And then for delivery expense, we simply apply 10% on the expense amount of 4,000, which is 400. So on that basis, the total GST paid on cash payments comes out to $1,400. Now, a lot of students I've seen made mistakes or had confusion where they asked me about the second point in the additional information. A payment of 16,000 will be made to the ATO in September 2016. So they were confused that this could also refer to GST paid, but this is referring to the GST settlement to the Australian Taxation Office. GST paid refers to the GST we pay on cash payments, and the GST settlement is normally what you will get to see included in the additional information, and that is $16,000 paid in the last month of the reporting period of September 2016. So we do not include that as part of our calculations here. Now, the next requirement, which was to prepare the operating activities section of the budgeted cash flow statement. So let's do that. Now, before we move further, I need you to understand that the cash flow statement simply shows all the cash inflows and all the cash outflows for the business during a specific period, which are the 3 months of July, August, and September for our question. So what we're going to do first is quickly write the title here. So I'm just going to be straight to the point. So Appcon Air might be a bit messy. So let's just say budgeted cash flow statement. For the 3 months ending 30 September 2016. And we can draw 2 columns. We can just have an outline with 2 columns. And obviously, all the amounts are expressed in Australian dollars. So we're going to start with the operating activities section, and that's the only requirement for this particular question. So first of all, we need the cash inflows. So the cash inflows refers to the cash that we have collected from our debtors or from our accounts receivable. So we're just going to write cash collections from accounts receivable. So I'm just going to write cash collections in short, but in exam, be sure to specify cash collections from accounts receivable. Now, where do we get this amount from? If you remember, today at the very beginning, we prepared the accounts receivable ledger account, and the main purpose of preparing that was to find the cash that we have collected or received from our debtors, and that was $225,000. So let's include that within the operating activities section. And I also need you to understand something. So this cash collections refers to collections for credit sales made in the past, which means this cash collections already has the GST included in it. So the accounts receivable who have paid us including the amount for GST. So you do not need to calculate that separately. You would have calculated that separately if all your sales were on cash, and then after recording the cash sales, you had to include another line for the GST that you received on this cash sales, which is not the case for our question. Next, we include all the cash outflows, and the first one is the payments that we have made to our credit suppliers. So payments to accounts payable. So where do we find this amount from? again within the reconstruction of the accounts payable ledger account. And you can see that on the debit side, we can see that bank of 121,450, which refers to the payment that we have made to our accounts payable. And this amount already has any GST or anything else, any GST factored in. So we don't have to worry about anything here. So payments to accounts payable of 121,450. Then we include payments for the GST settlement. That is what we get from the second point in the additional information, and that is $16,000. And then you also have made GST payments for expenses, which were your advertising and delivery expense, and the total was $1,400, as you can see here. So 1,000 for advertising and 400 for delivery expense, which makes it a total of $1,400. Next, we also paid for the expenses themselves as well. So the last line of the additional information says payments will be made for wages, advertising, and delivery expense. So we have the GST component for advertising and delivery expenses. So we also have the actual amount that we have paid for advertising and delivery expenses, which are 10,000 and 4,000 for advertising and delivery expense respectively. So let's include those two as well. So advertising of 10,000 within brackets referring to a cash outflow, delivery expenses of 4,000 referring to a cash outflow as well. And then we had one more expense of wages, which do not have any GST component because wages refer to salaries that you pay to your employees, and there's a personal tax associated with that, which we pay to the government on behalf of the employees. You don't have to worry about that now. So what's the amount for wages that we have actually paid in cash? Now, to derive that amount, you need to look into whether or not we have paid for all the wages. If you check the balance sheet extracts, you can see that the accrued wages are given under the current liability section at end of 30 June 2016 of $750. And then we also have the forecasts at end of 30 September 2016 of $890. So we have some liabilities to take care of. So what we do now is prepare a ledger account for accrued wages, which is a liability account. So liabilities by default have an opening balance on the credit side and closing balance on the debit side of the ledger account. This also means that liabilities, when they increase, we credit them, and when they decrease, we debit them. So on the credit side, you can see I've included the opening balance on 1st of July of $750 and the closing balance at 30th of September of $890, which is what you can get to see in the balance sheet extracts. Then we know that during the 3 months ending 30 September, the total wages expense are $38,000. So where did I get this amount from? This is referring to the total wages expense. That is what we get from the income statement. So which is what we have included here. Now this highlighted amount is what we had to calculate ourselves, which refers to the payment we've actually made for wages to our employees. So how does this work? Let's just say in Australia, the way things work, you work 1 week and then you get paid the next week. So all these accrued wages that we have could refer to the payment that we are still yet to make to our employees for the last few days or for the last week, which we take care of in the next period. So that is why we need to balance this and find out the amount that we've actually paid for in wages. So how do we do that? We find the total of everything on the heaviest side, which is the credit side. So 750 added to 38,000, which makes it 30,750 as the total of everything on the credit side, which must be the total on the debit side. As once you subtract $890, you get 37,860, which refers to the wages that we have paid during the 3 months. Because this refers to wages paid, this is a cash outflow, And that is why within the cash flow statement and in the operating activities section, because this is an expense, we include $37,860 within brackets because it's an outflow. Then you find the total of everything that we have here, and whatever you get should be 34,290, which is what we call the net cash flow from operating activities. You can write budgeted net cash flow from operating activities or estimated net cash flow from operating activities because the next 3 months, starting 1 July 2016 and ending 30 September 2016, are forecasts. So I don't think it really matters, but if you want, you can just write it here. That's all for today's lesson. I'll see you in the next video.